Markets continued to rally in the final quarter of what was an extraordinary year, spurred on by optimism around a vaccine rollout, a last-minute Brexit trade deal, and the US presidential election. However, COVID-19 cases rose sharply in much of the world, especially in Europe, triggering restrictions and fueling fears of further economic damage to come in the shorter term. However, stock markets again delivered strong gains, with the US equity market rising to a new high. The MSCI World Index returned a whopping 14% in the quarter in dollar terms, the UK and the US also recording double-digit returns. Emerging markets were the standout performers, and they returned 20%, led by Latin America and China. Our equity market also had a stellar quarter, with the CAPS Swiss delivering 11.5%. October was a bit of a weak month, but we had strong gains both in November and December. In terms of the sector contributions, financials had the largest gain in the fourth quarter, delivering close on to 20%, led largely by listed property stocks and banks. Resources returned 8.3% in the final quarter. This was supported largely from oil and gas, that being Sasol, and platinum, which also continued its strong gains in the final quarter of 2020. Industrials returned 7.5% for the quarter, and this was largely driven by the media sector. Overall, value strategies did well both locally and globally. Local bonds, also seen as a value play, had a decent quarter and returned 6.7% during the period. If we look ahead to the remaining of 2021, I think the substantial reduction in uncertainty delivered by the positive vaccine news as well as the Brexit deal have significantly improved the prospects for 2021, both in terms of a strong economic recovery as well as further progress in equity markets. Global interest rates are likely to remain low, which should also provide an underpin for growth asset classes. Within both global and local equity, there are pockets of the market which are trading at significant discounts to the broader market. We are, however, mindful of possibly stretched valuations in certain sectors and are cognizant of short-term market volatility. We have entered the year with our portfolios being overweight both local and global equity. We also have a meaningful allocation to both nominal and inflation-linked bonds, given the attractive yields on offer. We will continue to assess the economic and market environment and will make appropriate changes if required. In summary, we are cautiously optimistic that the world is in a better position compared to a year ago. This should support returns in 2021.